Kristen Weber, and I'm here with Steve Miller, Origin Ventures, and we're kicking off today with a little bit of background first with his family business that he was first involved with. That was his first taste. So Steve, why don't you give us a little bit of background on your family business, how that then kind of led you into the e-commerce, and we'll go from there.
Sure, yeah. It's great to be here. Thanks for having me.
Yes.
So my family owned a company called Quill. It was an office supply business that was an overnight success that took 42 years. My dad and my uncle started the company in 1956, and they knocked on doors peddling office supplies. Eventually they became a mail order company, back when people used to mail things using the U.S. Postal Service. And the original mailings that they did were postcards with five specially priced items. They were called penny postcards because it cost 1 cent in postage to send them. That's how long ago this was.
Wow.
Eventually the mailings of these postcards did more business than their sales calls were doing, so they became a mail order company. I grew up in that business. I worked there as a kid and learned the business. Eventually, after college at U of I in Champaign, I went back to Quill full-time. By that time, it was a real significant company. We had 1,000 employees. We were doing $500 or $600 million in revenue every year, mailing out 72 million paper catalogs a year, and shipping 30,000 cartons every day.
Where were you guys located?
So the headquarters was in Lincolnshire, Illinois by that time. Although we had 9 distribution centers across the United States and Canada. In fact, part of the work that I did after coming back to Quill after college was I moved to Toronto, Canada, and ran our distribution center up there for a couple of years. I made this mistake of moving there during the winter, which would have been similar to coming to Chicago during this past winter. Spent a couple of years there, learned a great deal. Came back from that, took P&L responsibility for a $30 million product line that we had. Learned a lot doing that.
Wow.
And while I was doing that in the mid-90s, the internet started to bubble up into the public consciousness. We had already been looking at what at the time were called CD-ROMs, which was...
Oh, I remember that.
Yes, so that was computer files that were stored on CDs. We looked at the possibility of sending out our catalog on a CD-ROM, because that would cost us a lot less to print and to mail to our customers than mailing out these big, huge catalogs were costing. And then the internet started to, as I said, kind of bubble up into people's consciousness. And so we added that to this task force that I was heading that was looking at what we called electronic media. And we decided, okay, this was something that for the office supply business was a channel that would be appropriate. We were selling commodities. People didn't have to touch or feel or smell them or taste them before they ordered it. It was, can you get it to me at the right price, and can you take care of problems if there are any after the order. Those were all things that we had been doing for 40 years as a mail order company. So the internet and the electronic commerce, e-commerce as it became known, was a natural channel, a natural extension for us in the office supply business. So I wrote the first business plan for Quill's website. Took it online in 1995.
Were most of the businesses in your space doing that, or were you kind of one of the first
You
ones?
mean our competitors?
Yeah,
we were one of the first ones to do that. Office Depot had started to dabble in it a little bit. Staples had not yet done anything online, and so we were one of the first to do that. Again, as a direct marketer, as a mail order company, we knew how to take orders, and ship them out, and all the back-end kinds of things that an e-commerce company, selling products, needs to know how to do. We already had been doing that for 40 years. We had all those skill sets and learned all those lessons. A big box store like a Staples or an Office Depot needed to do some different things. It was a lot different to run a big box store than it would be to try and ship goods in a direct marketing e-commerce kind of way.
Was there any friction when you were trying to, you said it was pretty natural to kind of introduce the website and the e-commerce, but was there any friction within the company or any hesitation or I'm not sure if this is going to work.
Well, sure. My dad and my uncles are in a different generation than I am. I had grown up with technology. My first computer was an Apple II Plus with 48K of RAM and an external floppy disk drive. I mean, I kind of,
Yeah.
I was never an engineer. I studied business,
Okay.
but I'd always been interested in how technology and business intersected and how technology could improve the way business was being done. So, it wasn't a slam dunk, writing this business plan and having it accepted. But we made the case and decided to make the investment in it, and it paid off because by 1998 we were doing $15 million in revenue annually on the Quill website.
Wow.
It was that, even though that sounds big, it was just 2% of the entire revenue of Quill as a whole, which was still coming in mostly via fax and phone orders.
But from an efficiency standpoint.
Sure, and
And-
yes, and accuracy, right,
Mhm.
exactly. Yeah, that's a great point. Customers were transmitting their orders to us. We didn't have to do anything with them like we
Right.
would if it was a faxed order that we'd have to type in. or
Keeps
if
your
they were-
overhead down to some extent, and everything
Right.
just, more efficient, quicker,
Sure.
better customer response.
Yes, which was the most important thing, that it was quicker service for the customer. So by 98, we're doing 15 million in revenue, and we sold the company to Staples. Staples wanted a direct marketing business to kind of plug into their big box business, and my dad and my uncles and the rest of our family got together and thought about it and decided that was the right thing for our family and for our employees and for everybody involved with Quill, and it turned out great. So in May of '98, we sold Quill to Staples.
That's, I want to touch real quickly on that point. Just even through my own experience with family business, it can sometimes be difficult to know when to sell, especially if it's, maybe for your father who started the company. It's, sometimes that's all they know, their identity is tied into it, their
Right.
emotion. How did you see that work from even like a psychological standpoint? And if there's any advice you could give someone, what would it be?
Well, search your heart and do that when you're starting the business. Do you want this to be a nice lifestyle business that provides a good life for you and your family for the next 25 or 30 years? Or are you interested in really going for the big kill and 5 years from now really perhaps having a great exit and getting rich, which is very rare. It's very rare to be a tremendously successful startup that goes on and has this huge exit. Most startups fail. Most entrepreneurs, even not in technology, most restaurants that start fail. Most businesses that are started fail. But really at the outset, before you ever started as an entrepreneur, you should think about what your goals are, what your long-term goals are. And that, I think, will help you determine what the right answer is to the question about exit, a question about selling. So in my family's case, as I said, we owned the company for 42 years. My dad and my uncles got to the time where they were looking at retirement, and we looked at my generation, and none of us wanted to take over the company, and so it was the right thing for our family to sell the company at that point. And we got a very nice offer from Staples, and we were able to benefit from that as a family. Our employees benefited because Staples did what is rare, I think, in acquisitions. In many cases, they let Quill be Quill. They let the acquired
Okay.
company sort of be its own thing. They didn't try and fit the Quill peg into the Staples hole. In fact, they still to this day, 16 years later, maintain the Quill name. It's now Quill.com.
I have a newfound respect for Staples.
Yeah,
I did not know
and
that.
they didn't put Staples people in to run the business. They had Quill people run the business even after our family exited. They didn't fire anybody. They looked for efficiencies and got those, but it really was a different company. Even though it was in office supplies, office products, it was not in the same specific kind of big box space that they knew.
I also think that speaks, though, a huge compliment to your family, the fact that they didn't come in and try to change at all what you guys had created. I mean, I think it speaks to how well you guys built this company up to, even when you exited, they left it alone and it's
Right.
still very successful.
Sure, and I'll take some personal credit for that because the headline in the Tribune business section the day after we announced the sale was Staples to purchase internet-focused Quill. That was the headline, even though as internet focused, it was 2% of our business.
Say.
But in 1998, I believe it was the law that every headline had to have the word internet or web in it. That was in the late 90s, it was very common for that.
Right, a touch and grabber, yes.
Exactly.
So then the sale happened, and you had to figure out what you were going to do.
Right.
So tell me about that transition, and maybe you were already kind of on the path.
So I
prior to the sale, or?
I had never considered venture capital.
Okay.
I was not I was a marketing major in Illinois in business. Never a finance guy. I was never in investment banking. But I knew in the last 2 years that I was at Quill that this internet thing was kind of cool and interesting, and it was going to fundamentally change the way business was done. It fundamentally changed our business at Quill. And so I decided, hey, you know what, I'm as exciting as the office supply business is, if my family didn't own the place anymore, that was not going to be, where I wanted to stay. But that I wanted to do something involved in e-commerce. And there were sort of three avenues that I could choose from. One was starting my own internet company. And in the late 90s, I could have started halfemptycoffeecup.com and gotten a $10 million pre-money valuation. I decided not to do that. I could have gone to work for somebody else. I didn't really want to do that.
Mm-hmm.
But investing in internet startups sounded like it was interesting to me. There was one tiny problem. I had no idea about investing in startups. I had no skill. I had no network. It's just a minor detail. But I knew about the internet, and I knew about e-commerce and building an e-commerce company. But if I could take some of the money that I received from the sale of Quill and some of the experience and knowledge I got in building the e-commerce side of Quill, I felt that I had the tools where I could go and be a venture capitalist investing in internet startups. But again, I didn't have any skill or training as a venture capitalist. So I networked the old-fashioned way. This was before there was such a thing as LinkedIn or Facebook or anything else. And actually, a real live person introduced me to another real live person. And we had an actual real live lunch where we met each other. That's how things used to be done in the olden days. We couldn't Skype with each other because Skype hadn't been invented yet. So I met my partner, Bruce Barron, who, although he had gone to U of I, he's older than I am, and we had never met in college. He at the time was CEO and chairman of a biotech company. And he was, again, a business guy, not a scientist. But he had raised a lot of venture capital money for biotech businesses over the years, had taken some of them public. He was interested in investing in internet companies, knew about the investing, knew about the venture capital part from the receiving side of the table. And he wanted to do internet deals but didn't know anything about the internet. I wanted to do internet deals but didn't know anything about doing deals. So at Yin and Yang, we formed Origin Ventures in 1999, and here we are today on our third
I
fund.
think that's an important thing to note. When you do co-found a business, to really have that good co-founder on your team that does complement you. I think sometimes people think, the same skill set is good to work with, but sometimes you really want the yin and the yang, like you said. They can bring something different, a different perspective, a different skill set, different background, to really provide a full round, strong team.
That's an excellent point, yeah. And in fact, not just yin and yang, but yang and yang and yang, and there's more than just two, I think, complementary skill sets, especially in technology businesses. We've seen a lot of examples of entrepreneurial teams that come to us where the three co-founders are all engineers, and that's great. They're really smart and they're really good at that, but chances are they don't have as much skill in marketing, sales, and finance as professionals who are marketing and sales and finance professionals have. They could really be brought into the team to really grow it into a business that's venture fundable if that's their goal. Totally agree. And in my family business, I grew up with that. My dad and his two brothers had complementary skill sets. My dad was the operator and the people person. My one uncle, Jack, was the marketing and advertising guy, and my late uncle Arnold was the financial and accounting guy. And
that's what you need.
It's absolutely, but that was 1956. There were no venture capital firms.
They figured it out then.
They did. They figured it out then, right? And thankfully, they didn't take any venture capital investment because 42 years would be much too long for a VC to wait for an exit. But they figured it out, and they made major decisions only unanimously. Even if one person who, if it was an issue, a major issue with the company, even if it was a marketing issue, or decision to spend advertising dollars or whatever, if it was my dad, the operator and warehouse guy that had a problem with it, or if it was Arnold, the financial and accounting guy who had a problem with it, they still wouldn't do it unless they were all convinced.
That's great.
Yeah. So, and I'm not necessarily advocating that has to be the management style and the way that you execute major decisions in a company, but you should definitely build a consensus. But my point definitely is you shouldn't all agree all the time on everything.
Right,
you
you
have
should
to have a
challenge.
diversity of opinions, consider other ways of doing things, and other ways of thinking. Otherwise you're going to miss opportunities for growth and miss solutions to problems.
I do see one thing, you've got maybe the engineer or the person with the idea that knows how to develop and but not necessarily maybe implement, and more importantly sell the product, because there is the sale person is vital to the beginning stages, and sometimes I think that's overlooked.
The old saying is nothing happens until somebody sells something. That's an old saying, and I think it's true. And it's also true, one of the things that we look for is companies that bring out MVPs, minimum viable products. I've seen situations where engineers are so focused on getting every line of code right, every bug out, and every feature in the system before they ever release version 1.0, and that's a mistake. I think you need to get the MVP out there. You need to have customers teach you what they want, what the issues are, what their needs are that are not met yet, and learn from that and iterate and continue to do that.
That's a very important point I want to make. So, real quickly, your focus is on investments, or 3 areas from what I understand. So if you want to touch upon each area, and then we can maybe elaborate a little bit to what you just said about doing iterations of the next best product based on customer feedback.
Sure. So Origin Ventures is my firm, and Bruce and I continue to be partners in it. We've added a partner named Brent Hill and an associate named Eric Olson within the last year and a half. We're on our 3rd fund. Origin 3 is a $47 million fund. Origin 2 was a $15.5 million fund, so we've tripled the size of the fund here. Thank you. A lot of that had to do with one of the portfolio companies in Fund 2, a little company called Grubhub.
Minor company.
Yes, it was when we invested. We led Series A and Series B in Grubhub. When we first invested in Grubhub, it was 5 employees, the entire company, in a room about the size that we're in right now, which for those of you who are watching this don't see the size, but you're seeing most of the room right there. So there were 5 employees. It was a typical startup. They had 100 restaurants, all in Chicago. That was the entire company. And we led Series A and Series B and helped them grow and introduced them to folks like Chuck Templeton, who helped them grow. And as we all know, that became quite successful. So it was very helpful, not only for Origin Ventures, but great for the guys at Grubhub, Matt and Mike and the rest of the early folks at Grubhub. Great for Chuck Templeton, great for the Chicago entrepreneurial ecosystem. So that's been a great story. On the strength of the Grubhub deal, we were able to really expand our fund and our footprint. So we at Origin Ventures focus on Series A companies. We're not seed investors, so we prefer to have kind of the team worked out, and if there's holes on the team, that's fine, but we want you to be honest with where the holes are. You're a great engineer, you got a great engineer and a great marketing person, but you have nobody on the finance side, or you really need to beef up the sales team or whatever. We need you to be honest. For Series A, don't expect you to be a fully completed blue chip team. We invest in e-commerce. You mentioned 3 things: e-commerce, social media, digital ad technology. Those are the 3 spaces that we focus on, and we do that because that's what we know. We were able to bring our experience to bear and our networks to bear to really help grow and strategize with our entrepreneurs to really help scale.
There's been some interesting articles written lately, as I've been reading out of the East Coast, where venture capital guys are talking about the relationships they have with entrepreneurs. How would you say your guys' relationships are with the companies you've invested in? Is there anything that you're looking for from the entrepreneur, like, being open and honest? Do they feel like they can because maybe they want to appear like a rock star, since they want your support, they look up to you guys? Tell me a little bit about that relationship.
So if they're going to take venture capital, for any entrepreneurs that want to take venture capital, and it's not appropriate for every entrepreneur out there, but if you've decided that you want to scale the business, that it's really important for you to grow and have an exit in 5 to 7 years, and you really need X millions of dollars to get this thing to accelerate, then we need them to think like shareholders. We want them to be incented the same way we are, which is the growth of the value of our shares in the company. We don't make money until there's an exit, until we're able to sell our share for, hopefully our goal is 10x the price when we invested. And so yes, I want them to be open and honest about what their strengths are and what their areas of need of development are. That absolutely is necessary from before we even write a check all the way through. I do not want them, as I said, as I think I may have implied before, I don't want them to agree with me all the time. I don't want them to agree with each other all the time. I don't want them to agree with the rest of the board all the time. I don't want to agree with the rest of the board all the time. I want there to be healthy discussion about differing points of view. And I want everybody then to come up with a consensus. And once we have a consensus, I need the team to run through brick walls to execute that and make that happen. I'm going to do the same thing. I'm going to make introductions in my network to potential team members, to potential business partners, to potential customers. And I'm going to do whatever I can to really help grow and scale that. And I want them to do the same thing.
It sounds like you've got a really unique spin in that you're not just the investor, you're almost like the co-founder with this team that's running with this idea, and you're supporting them. So it's not like you're just the money supplier. You really want to help them in any way possible.
Yeah, I think that's well put. And if all they're looking for is money, then Origin is not. And actually, most good venture capital firms are not going to be right for them. Mm-hmm. They should go get angel money from some dentist that knows nothing about their business, but maybe wants to take a flyer on something. That'll be a silent partner who won't talk to them, and won't bother them, and won't call them all the time. Sometimes I bother, sometimes I call all the time, but not all the time. Listen, when the business is going well, then those conversations are nice to have. When the business isn't going well, then we hope to have constructive, positive conversations about how to make it go better. And yes, we see ourselves as partners with the entrepreneurs in helping the business scale.
Right, because everybody has to succeed for this to be a win-win for everyone. And
like I said, I don't make money until there's an exit, and I don't want the entrepreneurs eating ramen noodles, but they shouldn't expect that they're going to get $250,000 a year in salary for an entrepreneurial startup either. Their incentive should come again in the form of the growth of their stock.
Mm-hmm. When you're looking to invest in, you probably get a ton of inquiries. Look at my startup, look at my startup, look at my team. What do you look for? Besides, your investment parameters in terms of the segments that you feel like you have expertise in.
Right.
Within the individual or the teams, what do you look for? What traits, character traits, kind of the softer stuff besides just the idea?
Sure. Well, I've touched on a little bit of that. The open-mindedness, the honesty, the honesty with themselves. That hey, I'm a great salesman, but I know nothing about the technology. Or I have a great idea, but I have no idea how to actually execute it and make it happen. So absolutely look for them to be open to augmenting their team, their skill set, not just with me and my partners, but also full-time people who come join the team as co-founders, perhaps. We're looking for people who are solving big problems out there, and we also don't want them to say we have no competition. That's a sort of a pet peeve. They should, if they say that means they're either naive or they haven't looked hard enough, or they're not
solving a real problem.
That's possible too. Yes, if there truly is no competition, chances are then there's no business there either. That's possible. It's rare for it to happen where they've somehow achieved the cure for cancer, and nobody else has done that, and it's a real problem. That's possible, but rare. Most important for me, and I speak for me, not necessarily Origin Ventures. My partners, have as I've said, have different points of view on things. We don't always agree on anything. For me, it is really all about the people. I would much rather invest in an A+ management team that had a B- idea in a B minus space than the flip side of that.
I agree with
Because
that.
chances are the A plus management team is going to make a business out of it. It's going to make some money for people, even out of a crappy idea. And the flip side, if you take a B minus or C plus management team and give them a cure for cancer, they'll screw it up. They'll do something that is not going to maximize the value of the business. And so for me, it's all about the team. And it's got to be, there's got to be a business there, and it's got to be defensible and have
Solving
competitive
a problem.
advantages and solve. It's got to have all the basics there, but I'm looking at the team first. My
Okay.
partners may dig in deeper on the technology, on the space, on the competition.
And you guys look at deals, obviously you're not just Chicago-centric, you look across.
Yes, we have portfolio companies in Madison, Wisconsin, in Cincinnati, Ohio. We have 2 of them in California. So, and the addition of Brent Hill to our team came to us from Twitter.
Oh.
Left Twitter to join Origin Ventures. He's got great networks in the Valley, in Austin, in Cincinnati, where Procter & Gamble was. He did a lot of work with them. Eric Olson, our associate, has great networks in Boston,
Okay.
where he's
Strong,
from, and
strong.
did some work there. So, we think that there's underserved markets in the United States for Series A venture capital for technology companies like we seek. We're not necessarily going to be a firm that should be doing deals in Silicon Valley. Chances are, if a Silicon Valley firm is coming to us for money, there might be something we should know about them, that why they can't raise money locally with all the venture firms in Silicon Valley. There may be a very good reason, and we may proceed accordingly. We may go and do a deal like that, but that's probably not going to be, the bulk of our deals are not going to be, where the hotbeds of venture money are.
So 2 quick questions. This fascinates me because I don't have that knowledge base that you do, but what is it kind of like peer-to-peer in the VC world? I mean, is it pretty competitive? Yeah, is it really competitive? Do people even share deals?
Yes, all the time.
They do.
We've said this very often about our colleagues here in Chicago, that we don't consider them to be competitors. We're colleagues. We co-invest a lot. We've co-invested with OCA, with Apex, with Hyde Park Ventures, and a number of others. We've co-invested with a lot of venture firms that are outside of Chicago. Benchmark, which is one of the bluest of blue chip venture firms, co-invested with us in Grubhub. It is a very collaborative industry, which is ironic because it's a pet peeve that I don't like when entrepreneurs say they don't have any competition, and here I am saying, well, we don't have any competition.
We're all one big happy VC family.
Do as I do, not as I say. But really in Chicago, I think that it's much more collaborative than I think in other parts of the country where there is a lot more money chasing deals. And so when things heat up, when there's a frothy market and a deal with a great team is getting bid up in terms of valuation, and there's 3 or 4 firms that want to do the deal, sure, there's competition. That's usually not a situation we're going to be involved in. But by and large, it's a collaborative industry. We're constantly sharing deals with each other. Many times it's because there's a deal that doesn't fit what we do. Maybe it's in nanotechnology, or it's in healthcare, or whatever. And we love the team. The sounds really interesting, but it just doesn't fit what we do. We will introduce them to colleagues of ours in our networks who we know do those kinds of deals. And really, the vast majority of conversations that start with teams are because it's been a warm introduction, whether it's from another venture capital colleague of ours, or whether it's from an attorney that we know, or whether it's from an entrepreneur we've worked with before, like Mike Evans, who co-founded Grubhub, forwarded a deal to us that we ended up investing in. Mike's involved as an advisor there, which is a big plus for us. But usually it's a warm introduction. It's very rare that a dialogue will begin with a venture capitalist just sort of if you send an email over the transom. You've never heard of me before, but I need $1 million.
Interesting. So what would be the one, we always end our eGuru series with one piece of advice that you would offer the audience, the entrepreneur out there watching this, trying to get as much information as they can. What's the one piece of advice you would leave them?
So this may be counterintuitive because I'm a venture capitalist, but I will tell you, only go and try and get venture capital if you absolutely, positively need it to do business. Most of the time, most entrepreneurs should not go and get venture capital. You are selling a piece of your baby to somebody who has a specific motivation, and if you don't share that motivation, and if your business doesn't require that rocket fuel to scale, then don't do it. You know,
That's very important, because I know there's a lot of people out there that don't know where to go for financing. Do they do the angel round? Do they do the VC? Do they try to do it on their own if they've got the means to do it?
It's a lot cheaper now than it was 15 years ago when we first started doing this. It's a lot cheaper to start up a company and scale and get traction and get customers. You can rent server space. You can hire people in Tanzania to code for you on an independent basis. You don't have to hire anybody. You don't have to have any space. You don't have to rent. You don't have to pay rent in a building. You don't have to buy servers. All of these things are available, and it's very cheap. And so you can get out there, test the concept, prove the concept, get customers, get traction, build value, see if it works. And if it works, really you've got assumptions then in your business plan that are based in reality and based on actual things that you've been able to accomplish. And then if your goal is to scale it, and you see a big market out there and you need funding for that, you've got a lot stronger case to make to a potential funder. Stronger case for a higher valuation. You give up a smaller piece of your baby, and you're in a better position to do so. But it's much faster and easier and cheaper to do this now, to bootstrap a company, than it was before.
It's been great talking with you today, and thanks so much for your time. Again, Steve Miller with Origin Ventures. If there's any last comments that you have, go for it. But otherwise, I'm assuming if anybody wants to check you out, just go to the website, originventures.com.
Right.
And that's all for today. Thank you.